So we're now in chapter 5 for capital cost allowance. In this chapter, the main topics for CCA and disposition of depreciable assets. So basically, we're focused on the two topics from this chapter. The rest of the information or the content, I would recommend you to read by yourself because it's not going to be talk about it in this online tutorial. So first of all, when we focus on the CCA, we first need to know what is a depreciable assets. And then there are examples including the buildings, equipment, automobiles, computers, furniture, etc. So those are where the assets lose value over time. And then we talk about differences between accounting and tax purpose. For accounting, allocate cost over estimated useful life. That's what we have been used or learned from the financial accounting courses. But for tax purpose, CCA, the capital cost analysis, is used. So is for the tax amortization purpose. And we amortize the CCA into different classes, and each class has a different rate. So first of all, for under capital cost allowance, we allocate depreciable assets into classes. Each class has a different rate. And then there's a rules you need to remember. November 20th, 2018 and prior. Actually, it's November 21st, 2018 and prior. Half-year rule applies to most classes. The half of the net additions. Okay, so we retained for some classes and situations after November 21st, 2018. Those are the situations, specific situations you could read from your textbook. It has mentioned about different classes. It will not apply for the half-year rule. And another one is after November 21st, 2018 is to the November 21st, 2018 and onwards, the accelerated investment incentive. This rule largely replaced the half-year rule. So this basically focuses on the period between November 21st, 2018 to December 31st, 2023. That was set up by the government. Okay, so quickly reminding, November 21st, 2018, prior is half-year rule applies to most of classes. And then after November 21st, 2018, accelerated investment center rules are replaced with half-year rules, but there are also some exemptions we're going to talk about in a later slides. CCA is also a discretionary deduction. What does that mean? That means that when the business calculate their max CCA deduction in a specific years, they can deduct from 0 to max in any amount in between. So the reason a business may not want to deduct the max amount of CCA is because they're already in a business loss situation. Okay, so they do not want to take the max CCA because if they're taking the max CCA, it will increase their business loss. They may not want to do that. Okay, I'll finish this. And we emphasize that the business calculates the max CCA. A business can claim from 0 to max if the company wish to take some of the CCA, but not the max. So this is from our tax planning strategy. So the tax planning strategy advised to take the lower rate of CCA and leave the higher rate into the future beneficial year. And so this kind of situation will apply to your after chapter assignments. We had our chapter 5-1 assignments, part B. They actually ask you, let's talk about. So after you calculate the max CCA for the company, and then they ask you as advisor, indicate how much CCA you would advise the company to take for the taxation year, and then the specific classes from which it should be deducted from. So that questions actually is foreign into this tax planning strategy. What that means is we need to take a look at the company's net income. And then when you take a look at, when you compare the company's net income and then taxable income or net taxable income. And then compare the max CCA you can deduct for that year. If the max CCA is much more than the company's total income, then the company may not want to deduct all of the CCA. So if they just need to deduct a few of the CCA, like just a few classes of the CCA, because according to the class, they have like 5 different UCC balance, okay? Then you need to figure out, according to our tax planning method, you need to apply for the lowest rate class. And then you save the high rate CCA deduction for the later year when they make more money. We're going to talk about that questions later after this PowerPoint. Okay. So one more time, I want to talk just say a little bit more about the Axillary investment incentive method. This method is trying to accelerate the amount of CCA that the business allowed to claim. They increase substantially the amount of CCA that can be taken on acquisition for the first year. So they give you more credit for the first year, but after the first year, they will go as a straight line, right, or declining method. But this method just they give you maximum of the amount you can take in for the first year of acquisition. Half-year rule is trying to limit the CCA that a business allowed to claim in a year acquired depreciation assets. So that's a big difference. When you go to a specific question, you will see that the half-year rule is you deduct half of the net addition. But for the Axillary investment center rule, you actually add back the half of the amount, right? We'll see some examples in the later slides. Okay, so we're talking about next one we talk about common classes. The common classes is you use your CCA rates table if they're provided. Basically, for the question, they will show you for each classes. But if you ever wondering like which product will goes to which class, you could refer to our textbook. We have a CCA rates for selected assets appendix. So that will be on your page 233. So you can take a look at that. They give you a very detailed analysis or explanation for each asset and which assets goes to which class and what is the rate. So I give you some common examples. This is also from our textbook. The first one is the buildings. Okay, so if I try to figure out the page number. So the buildings in general, class 1 is a 4% declining balance class. So but you either the class 1, you acquire this building after 1987, or class 3, you acquire this buildings before 1988. Okay, so if you acquire the building after 1987, it goes to class 1, and then it will take 4% rate. If it's before 1988, it goes to class 3, and it's 4%. But pay attention for class 1, 4% rate. If there's over 90% or more for manufacturing and process, the rate will go up to 10%. If is not qualified for the manufacturing and process rate, but it uses 90% of more for non-residence purpose, it goes to 6% for the rate. So that's a differences under buildings classes. Now equipment if is not listed elsewhere, it goes to class 8, the rate is 20%. The manufacturing equipment, we have to be careful. It will go to class 53. The manufacturing and process assets are allocated to class 53. So it starts 2016. So because after this classes, the CCA rate will be 50% applied. And then the automobiles is normally goes to class 10. Okay, the vehicle 30%. Or if for This is excluding the certain passengers vehicle that are located class 10.1. So for car acquired in children 1 through children 20, the prescribed amount is 30,000. So it's over 30,000, it goes to class 10.1. There is also a new rules for zero emissions vehicle. It goes to class 54 or 55 because this will have 100% deduction during the year. So that's a difference. This zero emission vehicles that would normally be allocated to this class are allocated to class 54, a class that provides 100% write-off in the year of acquisition. So there's a new rule. Computers. So we have a hardware and system software. It goes to class 50. The rate will be 55%. Computer application software, it goes to class 12, is 100% write-off during the acquisition year. Then the last one is the very common used one is a furniture. It goes to class 8. Its rate is 20%. So those are very common classes has been used. We will show a few examples. So the first example we're going to show. Calculate the CCA. The most classes calculate on decline balance, exception including class 13 and class 14. We're going to talk about 13 and 14 in the later examples. Class 13 is the leasehold improvement. We use straight line, not a decline balance. And then 14 is a intangible with a limited useful life. So that will be the straight line as well. So we're gonna just use some normal examples. This is for furniture class 8. ABC acquired 20,000 furniture. Is the total amount is $20,000 furniture. No asset in that class. So that's the only assets under class 8 on February 1st, 2018. Because it's before November 21st, 2018, so it's half-year rule applied, right? So how are we going to do the calculation? So we start with our undepreciated capital cost is UCC, January 1st, 2018, start with 0, because we just acquired this on February 1st, right? So our net addition, just pay attention to the net additions. Net additions always equals to additions minus the dispositions. Okay, so for this examples, we just acquired $20,000 furniture on February 1st. So our net additions is $20,000. Now we applied half-year rule, right? Because it's before November 21st, 2018. So we applied half-year rule. So we deduct half of the net addition. So it's $10,000. That's what shows right there. So it's $10,000 is a half-year rule. And then it gives us the total CCA base will be $10,000. We use 20,000, deduct 10,000. So we have our balance 10,000. We use this base to calculate the max CCA deduction. So this is for class 8, it's 20%. Use 20% times the 10,000. So our max CCA deduction will be 2,000. Now, when we close for this year, we need to add back that half net additions back to our max CCA deduction. So we add back the $10,000. The UCC December 31st, end of the 2018 will be 18,000. So think about a different way because it's deduct and add back. You just think about you spend $20,000 for the furniture, right? And during this whole year, you have a CCA deduction 2,000, and then how much left? 20,000 deduct 2,000, you have $18,000 left. So this will be your undepreciated capital cost for the end of the year. Okay, so that is for the CCA calculation. Next example, this will be the same example we used for this accelerated investment incentive method. So for this one, we will so the same examples, acquired 20,000 furniture, but there's no assets in that classes. This is the only class 8 assets on June 23rd, 2020, this year. So this accelerated investment center rules in effect, right? Because it's after November 21st, 2018. So the furniture equals class 8 is 20% rate. The same thing, we started with undepreciated capital cost January 1st, 2020 is 0, right? Because it's a new acquirement during the 2020 years. So the net addition will be, again, addition deduct dispositions will equals to $20,000. The net addition will be $20,000. Now, the accelerated investment incentive rules will add half of the net additions. So we add back $10,000 and we use this $30,000 as our CAA base to calculate the max CCA deduction. Then when 20% times the $30,000, you will have CCA max deduction $6,000. Now, because we already added back $10,000 to close for this years, we need to deduct the $10,000 of half of the net addition. It gave you the UCC on December 31st, $14,000. So this will be, think the same way that you spend $20,000 for furniture, and during the year you have a CCA deduction for $6,000. So end of their year, your undepreciated capital cost will be $14,000. So the add-in for accelerate investment incentive rules is add back the half of the net addition. Half year rule will be just deduct the half of the net addition. This add-in or deducted will have to add it back or deduct at the very end when you need to calculate the UCC. Okay, so very straightforward examples. Now we're going to talk about moving forward to focus on the accelerate investment intensive unless otherwise noted. So for all this rest of the questions, we're going to focus on this accelerated investment incentive rule. Accelerated investment incentive eligible on most depreciable assets acquired and available for use after November 21st and before 2023, I think. That's what I got from my book. Maybe yours is different, but according to my book, is 2023. Okay, so there are some so this accelerated investment incentive rule does not increase the total CCA available over life of asset. It's just enhance the amount of CCA deductible in year acquired. So it only works for the first year, but we'll take care for the class 12. This is 100% deduction. It is excluded from the accelerated investment incentive application. What we got this rules is on our page 211. They give you the examples on the class 12 assets. So some class 12 assets, such as medical, dental instruments, and tools, is costing less than $500. Uniforms and Chinaware. So these are under the accelerated rules, but the rest of class 12 assets, such as computer software and certified Canadian films, were subject to the half-year rule. So class 12 is half for the half-year rule, and the other half will go to the accelerated intensive the investment intensive rule. So make sure that you understand that. Now, if it's for not declining balance, is for using straight line classes, we need to modify our CCA calculation. So we're going to go to some examples so you will have a better understanding of those rules. Oh, here. Class 5. Well, common exemption to declining balance. That will has explanation on our page 212. So there are exemptions. We talk about these exemptions, class 13 and 14 at the very beginning of this class, right? Because class 13 is for leasehold improvements and is under the straight line method. So the max deduction is lesser of the two amount. So the calculation under class 13 and class 14 is different than the ones I just showed you. So under class 13, the leasehold improvement, you have to compare this two amount. 1/5 of capital cost, and the capital cost divided by the lease term remaining plus 1 renewal. Axillary investment intensive rules does apply to class 13. So we're gonna apply these rules to class 13. It's just the calculation is different. We're gonna give examples for that. Class 14 is a limited life intangible, is a straight line over a legal life. They use a prorated per diem basis. What's that mean is they use the date per date as a basis calculation. We're gonna example as well. And also the same thing, accelerated investment intensive rules does apply to class 14. Now, example, class 13, leasehold improvement is a straight line method, right? So ABC signed a 10 years lease on office space with 2 renewal option of 5 years each. During the year, ABC made a 300,000 of leasehold improvement to the office space. So we have to make deductions lesser of 2 amounts, right? According to our methodology. First one is 1/5 of $300,000 capital cost. This is equal to 60,000. And then the capital cost divided by the lease term remaining plus 1 renewal. We have 2 renewal, but according to our calculation formula, we only use 1 renewal. So it will be $300,000 divided by 10 plus 5 years, right? Because already signed the 10 years and plus the 5 years and then plus 5 years. But during the formula, we only use 1 renewal. So it's 10 plus 5 is 15 years. With $300,000 divided by 15 years is equals to $20,000. Now, according to our calculation, we times 150% under the accelerated investment intensive rule. Trying to figure out where is that example is located in our textbook. Yeah, so this is under our textbook, page 214, to give you the similar examples. So you times 115%, 115%. So for the first total amount is 90,000. For the second capital cost divided, this amount is 30,000. So when you compare the lesser of the 2 amount, you choose this capital cost divided amount is the max CCA will be 30,000. Okay, so this is for the first year, but for the next year, we're just straightforward to use a straight line. The straight line will be capital cost divided by the total list years, right? $300,000 divided by 10 plus 5, 15 years. So you get max CCA for the following year will be $20,000. You're going to use for that year's CCA. Okay, did I make it clear? Now, so this is for class 13 example. Now we're going to get an example for class 14. It's a limited life intangible. So we use a straight line over legal life. On April 1st, ABC acquired a franchise for 500,000, which has a 20 years legal life. The CCA equals to $500,000 divided by 20. So this is straight line. Your calculation is $25,000 per year. The initial year CCA equals to $20,000. This is according to our formula we just talked about, right, in our textbook as well. So you use $25,000 times April 1st to December 31st is 275 days. So you use 275 days divided by 365 days. So times the 150%, apply the accelerated investment intensive rules. That equals to 28,253. So the first year when you acquire the franchise, the max CCA deduction will be $28,253. And then the next year, you're just following a straight line rules, you get $25,000 per year for CCA deduction. So this accelerated investment intensive rule again only apply for the acquisition year, so the first year. Okay, so you can see that it's more than the rest of the year CCA deduction. So that's for class 13 and class 14 exemptions, calculation exemptions under the accelerated investment incentive rules. Now, that is all the calculation we need to focus on the chapter 5. Next night, we're going to talk about disposition of depreciable assets. Actually, for your homework, I don't know if you haven't encountered any questions regarding dispositions, but basically we focus on the calculation mainly, but I'm gonna mention about a little bit regarding the disposition. So the basic rule, we deduct lesser of the process of disposition or capital costs. We're gonna give examples, so easy. There are three different kind of situations. The first one, if there is a positive balance and assets still remaining in your company, so your company continue to take CCA. Okay, and then if there is a positive balance and there's no asset at end of the year, there is called a terminal loss. So we need 100% deductible, which means that there's no assets. We already dispose this assets, but we still have a positive balance, which means we took too little CCA for the company for the previous years. If there's a negative balance at the end of the year, we need a recapture. So we need to include this recapture total amount into our company's income, because that means the previous years we took too much CCA. Okay, so we're going to give examples under that rules, basic rules. But pay attention that even though this disposition of these assets, you still get a capital gain. If the proceeds of disposition exceeds our capital cost, the 50% of capital gain is taxable. But remember, very important, for disposition of depreciable assets, there's no capital loss. There's no capital loss possible at all. Now, examples. First one, example, disposition of depreciable assets. ABC Corporation has a opening Class 8 UCC balance of $110,000 during the year. ABC sold the only piece of equipment in Class 8 for $80,000. The original cost of that $80,000 pieces of equipment was $200,000. So we're going to do this question. We start our Class 8 UCC on January the 1st. January 1st, starts with $110,000. We deduct lesser of the original cost, $200,000, compared to process of disposition, $80,000. So $80,000 is less. So we put in there, deducted by $110,000 of UCC balance, deduct $80,000. So we have our balance $3,000. What's that mean? Does that mean that there is no asset left in Class 8, but we have a balance remaining? So that's our first situation, right? We have a positive balance and there's still assets remaining. No, this is a positive balance and no assets at the end of the year because we already sold it. So this is a terminal loss, which means that we originally spent $200,000 and we took CCA $90,000, and then it goes to our UCC $110,000. Now we only receive $80,000 when we sold. Okay, so it's less than what we bought from. So we have a terminal losses. We need fully deductible $30,000. I think I missed a zero. So $30,000. That leaves our UCC December 31st as zero. Right? So rules. If there's a positive balance and there's no assets left in Class 8, we are fully deduct this 100% deduct this terminal loss. So it leaves your UCC end of the year as zero. Another examples, we're going to talk about recapture. Similar, ABC has an opening Class 8 UCC balance of $180,000. During the year, ABC sold the only piece of equipment in Class 8 for $210,000. The original cost was $200,000. Start the same. UCC January 1st, we have 180. And then we deduct the lesser of cost, $200,000, or the process of disposition, $210,000. Now, our original cost is less, so we use the $200,000. We use our minus $200,000, deduct the UCC balance 180, it lifts our balance as a negative to $20,000. So that means we sold more than we bought for. So we paid $200,000 at the very beginning. We took the CCA of $20,000 and leaves our UCC balance $180,000. And then we receive $210,000 when we sold. It's much more. So we need to capture this as $20,000. Same thing as the rules. If there's a negative balance at the end of the year, we recapture this CCA. So we recapture this $20,000 and add back into our income statements. Okay, so we leave our UCC December as nil. Also, because we make money, right? For this sales, we sold 210 minus 200. So we have $10,000. 50% of that $10,000 will be goes to taxable capital gain. That's just $5,000 is capital gain. We're going to add it in to our income. So that's the examples for recapture for income inclusion, right? Because that's basically very easy to remember is you sold more than you bought from. You sold more and you compare the process of disposition and compare your original cost, you actually make money. So you have to pay tax on that money, capital gain you make, and also you need to recapture the $20,000 into your income end of the year. Now we are talking about one last two examples for the overall we have learned. So first one, ABC has opening classes 8, the UCC balance of $180,000. If it's for class 8, all the information will shows as big in this slide. So UCC January 1st is 180,000. During the year of ABC sold a piece of equipment in class 8. So there's still something left on their class 8, right? It's not all sold. Just a piece of equipment in class A for $210,000. The original cost was $200,000. Also, ABC acquired a new piece of class A equipment for $250,000. So what are the tax consequences and the max CCA that ABC may deduct this year? Remember that accelerated investment intensive rules applies only to the net addition. This addition minus disposition. It does not apply to negative. We're going to show this in our question. So take a look at the questions and try to do by yourself. You can pause the video and then you can come back to take a look at the answers. So the answers, class 8 UCC January 1st starts with $180,000. We add, because we have a new acquisition under class 8, so we add that $250,000, right? And then we deduct the lesser cost of $200,000 or the POD, the process of disposition, $210,000. So the original cost is less, so we put in there as $200,000. Then we use 250, deduct 200, 200. We have our net addition is $50,000. Always remember our net addition will be the addition deduct disposition, lesser of the cost of POD. So we have $50,000 of our net addition. Then we will use our accelerated investment intensive rules. We add 50% of the net addition. That is $25,000, right? Now our CCA base will be $255,000. 265, 55. Let me get it one. Yeah, so the total will be $255,000, our CCA base. Then our under class 8 is 20%. So we times 20%, that $51,000 will be our max CCA deduction. Then in order to close for this year, we remove the accelerated investment intensive 50%, $25,000, which is remove this total amount out. Then it left our UCC on December 31st as $179,000. Also, because the taxable capital gain will equals to, because we sold more than we bought, so we have our capital gain 50% of this $10,000. So it's $5,000 will be charged for tax. Now, next one. We're going to use class 10 as examples. ABC has an opening class 10 UCC balance of $20,000, consists of a Honda acquired for $28,000. Class 10 UCC January 1st, $20,000. During the year, ABC sold a Honda for $19,000. And then we acquire a Kia for $15,000. What are the tax acquisition and max CCA that ABC may deduct this year? So it means that under class 10, we have Honda and Kia, and we sold Honda and acquired Kia. Now, the question will be, start class 10 UCC January 1st, we start $20,000 from our question, right? And then we add the Kia, $15,000. Now we have our disposition. We deduct lesser of cost, $28,000. That's what we acquired as original cost for Honda, $28,000, and we sold for $19,000. Compare those two, $19,000 is less. So we use $19,000 as our deduct. Now we use our addition minus we use our, the net addition, we use addition minus disposition. And it gives you a negative net addition. It's minus $4,000. Because it's negative net additions, we do not need any adjustment under the accelerated investment intensive rule. Right? That's we talk about a lot of times, is that net addition always equals to addition deduct disposition, and it cannot be a negative. So there's no adjustment for ACCLL. Then the CCA base will just simply be $20,000 deduct to $4,000. The CCA base will be $16,000. Now the max CCA deduction will be 30% under class 10. 30% times $16,000 will be $48,000. And we live into close for this year, our UCC for December 31st will be 16000, deduct 4,800, it will be $11,200. So also remember, there's never a capital loss on disposition of depreciable assets. So we do not need to do any capital loss carry forward thing. So that's basically for our chapter 5. And pay attention to your CCA calculation if you are still get a little bit confused, because people are always get confused for the CCA calculation. It's more complicated. And then go back to your textbook. There are quite a few exercises during the book. It's a very good exercises, so you can practice by yourself, and then you can more get familiar with the rules. As promised for the homework assignment number 1, they actually showed you that 5 different classes and a UCC beginning balance, and then you need to calculate the max CCA can be taken by this company during the year. So the second one, they ask you advice to indicate how much CCA you would advise to take for the taxation years. So for this question, there's more CCA deduction compared to the net and taxable income, $53,000. So that business may not want it to deduct all of that, the CCA credit, to leave the company's net income as nil, because it's more than the net income, right? But it definitely, they could apply the $50,000, so it may leave the end of the taxable income to 0. But assuming that the CCA deduction is more than the net income, and then you want to deduct just a few of the CCA, according to the tax planning rules we just talked about, you always apply to the classes with the lower rates, and then leave the unused amount in classes with higher rates. So you return the maximize the amount that could be deducted in the first profitable year, right, in the future. So this is a basic idea how you're going to do your question number B. Hopefully I could make it easier for you to understand me. But yeah, just remember, do the practices. It will give you more, it will make more sense to you. Okay, so that's for chapter 5.